Netflix has had a nice run, really going back to last summer when price came down, hit this monthly bias level at the 175 level and has moved higher ever since. However, price now has pulled back from hitting a recent high of 487. It does find itself down if we go down to the weekly chart, entering the weekly bias level at $370. Now, for more analysts and the fundamentals on Netflix, let's look at this video. It's coming from TD Ameritrade Networks, and we have commentator George Tillis. He's going to discuss Netflix's recent stock decline, and he's going to highlight the structural challenges the company faces in terms of competition from content publishers like Time Warner and Disney. He also mentions Netflix's successful content creation strategy in the past, but suggests it may face challenges in the future due to potential content drought and increasing expenses. Let's look at the video.
Over the last month or so, what's your take here on Netflix? It seems like, everything was going right for them over the last year and a half, 2 years. They're beating down the competitors in this space, but then CFO gave some comments a few weeks ago, weren't positive.
Well, I think there's an interesting situation with Netflix here, Tom. If you consider the transition the business is making to become more of an advertising-based revenue generator, I think that's a good business strategy for the company. But if you look at the overall stock performance, especially in the last 30 days, the stock is down about 16%. I think there's some structural issues going on with Netflix. I think also that the stock is relatively balanced right now. I think you got to think about what's going on with competition, especially with content publishers. We got Time Warner, Paramount. We also have to think about Disney. They've got a huge catalog content that basically Netflix as a streaming service has to pay to distribute. I think at the end of the day, what we're starting to see is industry consolidation, particularly amongst the content publishers, the other competitors out there, that may end up strong-arming Netflix into paying a premium if they want to continue to distribute their content. So, in effect, what has Netflix been doing over the past, let's call it a decade or so? They've been moving to create their own content. Now, that content strategy business has worked out for them for the most part over the past 5 to 6 years, but I think they're going to be facing some content drought problems going forward. And I think at the end of the day, they're trying to offset some of that based upon the improving revenue trends that they're seeing from advertising. I think at the end of the day, also, if you consider what's going on from an earnings and sales growth, last quarter, when they reported back in July, sales were down below, in terms of growth, below 3%, but so were earnings. Now, on a forward basis, they are expecting earnings to improve to the low double digits, around 12.5% on sales, about 7.5%. The company itself is doing very well. If you just look at net income, it's about 13% of sales, as well as the fact that they're generating double digits in free operating cash flow. So they're improving their content creation. It's costly, but at the same time, their cash flow is also improving to help offset the cost of that. So I think right now, Netflix, if you look at it, it's trading right around its 200-day moving average. I think from a trading standpoint, it looks rather enticing. But I think from a valuation standpoint, I'm going to call it relatively balanced at this moment.
George, I want to read a quote that came from the CFO. He said, "Not prudent to keep growing at 3 percentage points margin per year." I think the street thought it would be prudent for them to continue to grow at 3 percentage points of margin per year. Basically, what he's saying is, look, we're not going to be able to cut costs to the extent that you want us to cut costs in order to continue to have a growth opportunity. Do you think that's kind of led to the sell-off that we've seen in stock?
Yeah, I think so. I think at the end of the day, if you look at even what's happened with the writer strike, just for example, I think it creates opportunities, especially when there's a lot of time to sort of digest what's going on, for them to go through their company and look for ways to cut expenses. And I think at the end of the day, Netflix really can't, from the standpoint of making it meaningful, because of the fact that they have such a huge expense for content creation. Now, that's certainly being offset from the additional revenues they're generating from advertising. But I think right now we're sort of at an inflection point, and I agree with them. I don't necessarily see margin capabilities to improve, especially when expenses are going to increase probably at the same clip that they have in the past. I think they're going to be generating more sales growth, But at the end of the day, you also have to consider, growth relative to valuations. And, looking forward, now next quarter looks like it's going to improve significantly compared to last quarter, 12.5%. But if you look at the next 4 quarters, their EBITDA growth is expected around 10%, with sales right around 10%. So that relatively is balanced. But if you look at their forward multiple, 31 times this year's earnings, but 24 times next year earnings, it's basically trading at 2.5 times EBITDA growth. So one would say maybe it's a little bit overvalued, but others would say, hey, that you could add a little bit of a discount factor to that, and to the point where maybe it's still undervalued. Let's say between $30 to $50.
Yeah, Joe, and that CFO in mid-September, he made some comments at a B of A conference, and one of the things he said was that the ad tier, not material yet, and operating margins continue to struggle a little bit. Is this just more of like a time frame type of scenario? Because I don't think they're going to lose a lot of subscribers, but at the same time, ramping up that ad tier has been slower than what they wanted, almost a walk instead of a run, according to CFO.
Well, I mean, in my opinion, it's something that they got to get figured out in 2024. George hit the nail on the head. We talked about, cash flow is really what is going to be valuing the stock going forward, and they've done a great job with securing and increasing that cash flow. But until they're able to really kind of monetize that advertising revenue to a point that becomes more and more substantial, you're going to have that intersection between the cost of content and that ad revenue generation, and it's only a matter of time, before we kind of see that become realized, and the hope is that happens in the first half of 2024.
Yeah.
All right, so let's go down to the daily chart, because what we're really looking for is some type of bullish reversal pattern, in order to see if price can move higher from the current levels. Now, all of this is a weekly buyer's level. When you look at the price structure on the daily chart, it's not ideal, meaning price didn't leave the level with strong volume. However, it is a flip zone, because you had a pivot high that was established back in February. Now, analyzing the price structure, you had this rejection wick in which the sellers push price back down. However, you do have price hovering right above the 200-day moving average. So for me, I need to see price stay above the 370 level in order to feel confidence that this weekly buyer's level at 370 has a shot of holding and working out. Short-term targets are going to be the $400 level, and then next the $441 level. Thanks for watching. Subscribe. Please like the video.